Zurich, the financial center of Switzerland, nestled in the valleys of the Alps. This idyllic location serves as the hub for managing trillions of dollars in wealth from across the globe. Capital that's nearly 4 times Switzerland's own GDP. But how did this small economy, 20th economy in the world, has been able to attract such massive capital from all over the world? Switzerland's success, built in the 1900s, rests on 4 key factors. Political stability, laying the foundation for the country's development. The strength of the Swiss franc, historically one of the most robust and stable currencies. Its political neutrality during times of war, from the world wars to the current conflict in Ukraine. And finally, the secrecy that for almost a century ensured complete confidentiality for capital from around the world, as Swiss banking secrecy was protected by the banking law of 1934. Over the decades, Switzerland has thus attracted trillions of dollars seeking stability and security amid the uncertain macroeconomic landscapes of the last century. All of this has led Switzerland to become one of the global financial centers, holding approximately 9% of the world's assets under management in 2004. At that time, no one could suspect that the secular growth of the Swiss financial market might somehow cease or, worse, decline. However, this is where the Swiss economic dilemma begins, the point at which state finances intertwine with private Swiss banks in a relationship of total mutual dependence, where one cannot exist without the other. This poses a concerning risk for Switzerland, a factor that renders the entire Swiss economy vulnerable to the trends of the banking market. The first major upheaval for the Swiss banking sector involves UBS, one of the world's largest asset managers. During the subprime crisis and the collapse of Lehman Brothers in 2007, UBS finds itself highly exposed and enters into a severe financial crisis, prompting Switzerland to rescue UBS with a bailout aimed at safeguarding the overall Swiss banking system. The first Swiss banking operator is saved by the Swiss government, and this takes place in 2008. However, complications for the sector do not end here. At this point, the Swiss banking sector faces its first blow, beginning to erode investor confidence. Assets under management managed in Switzerland dropped from 9% of the global AUM in 2004 to just over 4% in 2009, following the UBS bailout. Soon after, in 2010, one of the pillars of Swiss economic success is directly targeted by the Obama administration. The American president signs the Jobs Act, approving a section called the Foreign Account Compliance Act. With this measure, Obama compels U.S. citizens to declare money held abroad, subject to severe sanctions. As a result, all banks, including Swiss ones, are forced to start sharing information with the United States regarding American citizens holding capital in Switzerland. Following the UBS bailout and the signing of Obama's Job Act, investor confidence in Switzerland takes another significant hit. But the problems are far from over. With a series of legal proceedings involving the United States, 85 Swiss banks find themselves in hot water, becoming embroiled in sanctions imposed by the U.S. on Swiss banks due to their conduct that facilitated tax evasion cases involving American citizens. UBS is forced to pay $780 million in 2009, but the harshest penalty is levied against Credit Suisse, receiving a fine of $2.6 billion in 2014. In this moment, as a consequence of repeated attacks on the Swiss banking system, the global AUM share, which had already declined from 9% to 4% in 2009, further drops to 2.2% in 2015. Before we delve into the event that radically changed the Swiss banking system, remember to subscribe to Vision Economy to learn more about the economy and markets, with a focus on key market data and clear infographics every week. From this point onwards, a spiral of problems begins to engulf Credit Suisse. The decline of the Swiss bank is clearly observable through the oscillation of its stock prices. From 2020 until the acquisition by UBS, a series of scandals and poor management choices unfolded at the Swiss bank. The first sign that something was amiss came in February 2020 when CEO since 2015, Jane Thiam, resigned following the espionage scandal within the bank's management. It emerged that two former employees had been put under surveillance, although the ex-CEO denied knowledge of the operations. Between 2008 and 2023, Credit Suisse's investment banking arm underperformed, dragging down the business's profitability and causing significant losses. Particularly noteworthy were the recent major failures in the corporate branch, notably involving Archegos and Greensill. Archegos, the family office of billionaire Bill Huang, defaulted on March 26, 2021, due to margin calls from various investment banks, while the German Greensill filed for insolvency shortly before. The decline of the bank continues with further scandals and changes in leadership. But the point of no return comes with the panic following the failures of Silicon Valley Bank and First Republic Bank. Depositors, influenced by negative rumors about the Swiss bank, begin to withdraw their money, causing a massive outflow of hundreds of billions of dollars. However, the day of the final collapse occurs following statements by Amr al-Khudairi, chairman of the Saudi National Bank and the largest shareholder of Credit Suisse. He declares that he would not inject any more money into the Swiss institution during this particular period of collapse. These statements from the bank's major shareholder trigger the Swiss bank's last chapter. Trading in the stock is halted by the Federal Financial Market Supervisory Authority, and a meeting is convened to decide on the future of Credit Suisse. The Swiss government, having assisted UBS in 2008, cannot save Credit Suisse from bankruptcy. Therefore, a third party is called to the negotiating table, UBS itself. The Swiss state identifies UBS as the only player capable of merging with Credit Suisse and saving the Swiss banking system. Both intend to proceed with the operation, but on their own terms. Thus, after days of negotiations, on March 19, 2023, UBS agreed to buy Credit Suisse for $3.2 billion in an all-stock deal brokered by the government of Switzerland and the Swiss Financial Market Supervisory Authority. The effect of this acquisition was a transfer of over $1.2 trillion in assets, with UBS going from managing $3.3 trillion to almost $5 trillion. A series of events triggered by Credit Suisse prompted the Swiss government to intervene decisively to avoid the collapse of its banking system. This series of actions had a dual impact. On one hand, it preserved national financial stability, and on the other, it created what could be a significant problem for Switzerland. It created a banking giant that appears as a behemoth in the Swiss banking landscape. All this does not come without associated risks for Switzerland, one of which is the oversizing of assets under management. UBS holds assets under management almost 4 times higher than Switzerland's GDP. Switzerland is also the first country in Europe when it comes to this particular metric. This disproportionate size can become a significant risk, as any financial difficulties in UBS could have a devastating impact on the entire Swiss economic system. Excessive dependence on a single financial institution, where managed assets exceed the economic size of the country, creates systemic vulnerability. Another area of weakness emerges: market concentration and excessive control. The merger with Credit Suisse has led to an unprecedented market concentration, with UBS now holding 30% of the Swiss banking sector. While this centrality may increase control over the industry, it raises serious concerns. Risk management becomes a critical challenge, and excessive control by a single financial entity can negatively impact system stability and competition in the Swiss financial sector. Finally, there is an additional area of concern regarding the impact on employment and society. UBS's expansion has resulted in a significant increase in the number of employees in the financial sector, involving over 5% of the national workforce. This numerical increase not only creates high economic dependence on a single sector, but also the risk of widespread job losses in case of financial difficulties. The social impact of a potential reduction in employment could extend well beyond the financial sector, influencing the entire Swiss society. In summary, the size of UBS in the Swiss context is a phenomenon with multiple facets. While it brings advantages such as market control and centrality in the financial landscape, the three main risk factors outlined emphasize the need for a balanced approach in managing this imposing presence in the national economic system. If you are still watching this video, I'm sure you would like to see more of our content. Subscribe to Vision Economy to learn more about the economy and markets, with a focus on key market data and clear infographics every week. Until next time from Vision Economy.